I have a very special guest with me today, a good friend of mine, Scott Foster, and he's been watching me as I was doing this video, and I'm going to open it up to questions for him and see if he has any questions on opening up these kinds of positions. Just put you on the spot.
Okay. Well, hello, everyone. This is Scott Foster. Anyway, it's a pleasure to be here, Dave. And, I don't have any questions at this point. I'm still digesting this because this is the first time that I've actually sat and watched this. But I am very intrigued by this. And, in fact, you're encouraging me all the more because I've always wanted to learn how to make money in stock trading and options, as I've learned here. And so now I see it as a way I can actually do it. So, this is just great. So I've been taking notes, and so at this point I don't have any particular questions for you, but I just want you to keep going because I'm enjoying this.
Do you think it was clear enough the way I presented this to show you how to enter these positions?
Yes. I think you really simplify it when you say that there's two rules, and that is one, that prices will fluctuate, and number two, that options will expire. So I mean it doesn't seem to be any, that's probably the most simplest way I've ever heard it put. Because at first glance when you look at all of this with the software, it looks really confusing, but you're just really simplifying something that it looks very confusing. So this is awesome stuff, Dave.
That's great. I'm glad it's really clear because I want to make sure, and Scott really has no stock or trading experience. He was very interested in stocks several years ago, right?
Yes.
And but he doesn't have any experience trading stocks or options at the moment. And so for him to say that this is fairly clear, it's really, really encouraging to me because I want to make sure that everybody is very clear on how we set up these positions. And also the fact that we are taking advantage of the two most important and violent rules of the market. Prices will fluctuate and options expire. So we're taking advantage of both of those really and most important rules. When we set up these positions, now remember, if I go back to our Analyze tab here for a second, I'm going to take a look at, I'm going to delete our simulated trades, and I'm only going to take a look at our portfolio here. We are, we want to set up a balanced portfolio. In other words, we're going to do some double calendars and we're going to do some iron condors. And this gives us a very, very nice profit picture here for our positions. We want to make sure that we are have a nice high profit picture or profit tent here, and that we're always kind of close to the center of the price movement because we want to take advantage of the fluctuation in the price, and we also want to take advantage of the expiration of these options. So let me just show you an example of what happens. And with the TOS platform, you can actually go up to this thing called Daystep, and what it'll show you is what the profit potential of this position is over a number of days in the future. And this is pretty interesting. Right now, our current profit position looks like we have about, let's see, I'm going to set these slices back here. We have a small loss for the day, but remember, we just started this position. Now, if we take a look at our center price here, and take a look at this green line that seems to be flashing incessantly and annoyingly, but you can take a look down here on the left-hand corner. The green line is a date in the future, and that happens to be April 30th, which is just about 7 days away. In 7 days, if price movement does not dramatically go one way or the other, and we stay in a relatively narrow range here in the market, we will have moved from a loss of about $50 to a profit of $217. If we project out further, we go up to this blue line. If price again prices always fluctuate. That's the rule of the market. But however, if we keep our profit potential of this position under the current price, we will have a profit potential on May 7th, which is another week out, of $591. So as you can see, when I said that this white line will eventually move up towards our expiration position, because this is what it'll look like at expiration, it really does over time, week by week, continue to move up until we get in a really nice, profitable position here. So this is week 1, this is week 2, this is week 3, and that's the kind of profit potential you can expect to have. As I've mentioned many times, it's very important to monitor at least your position on a daily basis, and it doesn't take a lot of monitoring. We've done videos on monitoring and reviewing your positions. It only takes about 10 or 15 minutes a day, and then you can go out and do whatever you want. Generally you can, if you got a day job, go to, you're talking about 10 minutes of just reviewing your positions. This is something that you can monitor either from work or on your lunch hour. And also, if you're, if you're an entrepreneur, or if you have a position where you can monitor these on a regular basis, it's only going to take you 10 or 15 minutes, and that's all you really need in order to run this business. And the profit potential is absolutely awesome. So I can't think of a better way to trade than this, because when you simply buy a call or you simply buy a put, you're really putting yourself into a position where you have the potential of losing your entire investment. If you're not correct in both direction of the underlying stock that you want to see, if you're buying a call and you want the stock to go up, you got to be right on direction, but you also have to be right in your timing, because if the stock does not move within a few days after you buying your option, you can see how much those options will actually decline in value the closer you get to expiration. So that's how we build our portfolio. We use 2 primary ways of building it. We use double calendars, and we use the sale of iron condors. And you can also, as you get more experience, you can add additional strategies to your positions. You can use regular double diagonals, which have a little bit more margin requirement, and they're a little bit trickier to adjust. But that's why I suggest for those, for you guys just starting out and building really profitable positions, is using the double calendars. The margin requirements are very, very low. If we go back to our trade tab here just for a second, on the sale of this iron condor, even though we're doing 5 contracts, the margin requirement is about $2,000. If we were to do the double calendar at these positions, and we'll go back to these here. Whoops, I selected the wrong strikes. This is the original double calendar that we had selected. Let's see. Let's go up to. Normally, when you're starting out, you want to do between 1 and 3 contracts. The margin requirement is only $1,700. For the profit potential, as we said, well, with 3 contracts. The profit potential on this is $1,000, and you're only putting up a $1,700 in margin requirements.